Hello everyone, welcome to the Trendline Investor channel. Today we're going to discuss about stage analysis by Stan Weinstein. Now I've separated this video into four different series or four different parts. So it'll be a series of videos. So it's going to take some time to get all the videos out. So do stay and watch the entire four series episode, which will come up in the next 4 weeks. So it's going to be very interesting, especially if you are a beginner and if you're struggling to understand how to understand technical analysis. This is probably the video where you have to start off with. Okay, now stage analysis is a very simple concept, and this picture is one of the most shared pictures on social media, Twitter, YouTube videos. And Stan Weinstein actually has done a very good job explaining this concept. Now, he basically thinks that with stage analysis, you can easily find stocks which are going up, which are going down, even before there is any news in the markets. So basically, he says that the tape tells it all, which means any news in the markets any news about the company will be known by markets much early in advance or very, very early in advance. And the stock's price tends to move even before the news is out. Right? For example, if a company is about to turn around and post very good results, the company's stock price will ideally start turning up and heading higher. On the other hand, we could also have companies which are already going up for quite some time because of very good results. And then suddenly it starts going down because the markets are expecting that the companies might not post very good profits going forward or very good growth going forward. Like we've seen many cases like this in the pharma stocks, especially in the last couple of years. Okay, so Stan Weinstein discusses four stages in any stock. So any stock will be in any of the four stages that I have shown here. One, it can be in the basing area, which is called the stage one. It can be in an advancing stage, which is stage two. Can be in a distribution base or a top area, which is stage 3, or it can be in a declining phase, which is stage 4. Right now, these are the simple four stages, and there are certain set of guidelines that Stan Weinstein has suggested. So we're going to look at just stage 1 in this part of this video, and I'm going to explain what the guidelines are. Okay, so let's get started with first, what is stage analysis or what time frame it is applicable for. Now, stage analysis is applicable mostly on weekly time frames. Now, there are people who apply stage analysis also on intraday time frames and other time frames, but stage analysis is best suited for weekly time frames and for long-term investing or trading, which ideally should be many months to many years. Right now, that's where stage analysis is actually applicable. Second thing, in terms of the tools required, you do not need much. You just need TradingView. The free version is totally fine. You could use the free version. Along with this, you need to have the moving average indicator applied. You could use the simple moving average, exponential, weighted, any moving average is fine, because you're looking at weekly charts, the impact would not be really big. If you use simple or exponential weighted, the impact will not be really big. So if you want to really keep it simple, use the exponential moving average, which should be fine for this strategy. And last but not the least is volumes. So you want to see some characteristics of volumes, which will define the stage of the stock, and that will help us make an informed decision. Okay, so I have this chart in front of me, which is Cupid. So this was Cupid's price action somewhere between 2009 to 14. And I've taken this as an example to go through the guidelines that Stan Weinstein has. Now, one of the first important rule in stage 1 is the stock must be declining for many months or many years when you're looking at the stock right now. For example, if I'm looking at Cupid chart, let's say as of today, then let's say I'm here somewhere here and I'm looking at the chart, the stock has to be already declined. And the stock must be, at least a few months or a few years declined. The stock should have already declined for several months or several years, right? Now, that's the decline phase. Now, after this decline phase, so the downtrend here has been very strong, right? Now, once the downtrend has been very strong, after that, the stock starts going sideways. Basically, here, what Stan Weinstein is saying is that the stock loses the downside momentum. Basically, it was like a falling knife, but then that momentum has completely gone and the stock is now going sideways. Now, that's what you see here on the long-term charts. The stock has been going sideways. Now, that's the rule number 2. Now, this is very, very important for stage 1. In a stage 1 stock, usually a stock has to go sideways, and that's how it loses the momentum of the sellers. So sellers have been very strong over here, and then now the sellers have lost momentum and the buyers are probably also fighting it out, and sellers and buyers are almost in equilibrium, right? So they have equal power here. Neither the sellers have upper hand and nor the buyers have the upper hand. That's the simple rule, right? So that's the third point. The fourth point is, while the stock is in sideways, like this, you must see volumes completely declining. Now here, if you see, the stock has completely declined. So you see some spikes in volumes, which is normal, but otherwise the volumes have been completely dried, right? So basically, which tells there are not many people to sell. Now here, if you see in this move down, there has been some spike in volumes, and the volumes were even higher than these days. And finally, the volumes have started drying up. Now in a downtrend or an uptrend, the volumes have to rise, or volumes have to rise, but in a sideways trend, the volumes have to be low. Now that's an important rule in stage 1 analysis. The next is the 30-week exponential moving average, or the moving average. You could use anything. Now in the 30-week moving average, before a stage 1 starts, the moving average is basically falling very fast and sloping downwards. Now in this base 1, or in this stage 1 phase, the moving average needs to be kind of going almost flat. Right now, if you see here, this is a perfect example of a moving average going flat in this phase over here. So basically 30-week moving average loses the downside momentum and it starts going flat. Now from here to here, if you probably smoothen out a little bit more, it'll kind of be little not as steep as this moving average over here, right? And then the next rule or next guideline that Stan Weinstein discusses is we will have intermittent rallies above and below the moving average. Now if you see here, we had this massive rally here, and then again a massive rally down, a massive rally up, a massive rally down, a massive rally up. Now it is very important to not get confused with this rallies up and down. Now many of the people, what they would do is they'd probably buy the stock somewhere around here, and the stock falls down, and they will get fed up of this, and they will literally say, okay, this is not working, right? Now that's not how you do it. Now ideally, after a move up, you need to wait for the stock to consolidate and go sideways, right? Now here, this has been a very strong downtrend. Now usually after a very strong, now if you see this angle of this trend line, it has been very steep. Usually after a steep downtrend, the stock usually tends to rise. Now you should not go and buy the stock immediately somewhere here or here, because after this rise, the stock is going to consolidate, right? So you need to wait, and you need to see and give it some time before the stock forms a base and enter. Now let's say, for example, you entered here by chance, thinking, okay, the CCI has crossed 100, all the rules that you have followed, that I've discussed in my past videos, you have followed, and probably let's say you entered here, then you must exit the stock somewhere here, right? And it's okay to enter a stock thinking that this is entering now a stage advancing phase or a stage 2 phase. It's totally fine to just think and enter the stock, but you need to exit the stock if your stop loss hits, right? Now that's a simple rule in terms of risk management. Okay, anyways, so the next point is, now there will be several swings and between above and below the moving averages. But what you need to make a note of here is what are the significant highs and the significant lows. One of the significant highs for me is here, here, and here, right? So if you just plot this point, so you'll have a nice horizontal resistance around this point, right? Also, in terms of the base, you'll have a nice support here. If you just connect these lines, you're probably having a nice support around that zone over there. So it's very important to mark the range of this entire stage 1 base. So while you mark it, you can just probably draw a line there and draw a line here and say, okay, this is the range that the stock is oscillating between. And if the stock breaks out above the range, that's when we go long. Okay. And this, just remember one thing, the last thing is this base action can go on for several months, right? Now, these are the 8 guidelines that Stan Weinstein suggests, and it is very important to follow these. Not many of them will actually be to the T, but you need to at least follow them and see how you can work around them, right? Now, as and when you spend time in markets, you will get a hang of this and you will understand it. You don't have to really plot a moving average, but you will understand it automatically. So these are the 8 guidelines, but there's a very strong reason why you should not buy a stock in stage 1. Now, let's say like you try to attempt to buy the stock around here, right? Or you try to buy the stock somewhere around here. Now, the reason why you should not buy a stock when it is probably coming back and it is still not out of stage 1 is because there is an opportunity cost. Now, if you probably bought the stock somewhere here, yes, you might probably get some returns, but the stock again comes down. So from an investing perspective, even if you're buying a stock somewhere on the bottom, try to not put too much of your capital and ensure that your capital is not stuck, because there is an opportunity cost involved if you buy a stock which is in stage 1. So a stage 1 stock can go sideways for many years or many months and your capital is basically stuck. So even if you're investing, invest a very small amount, and then when it breaks out of stage 1, that's when you go on with a bigger capital size so that your money is working for you. Okay, so now, yeah, these are 2 points because of which you should not buy a stock in base 1, in a stage 1, right? So what you should be doing is marking these levels So you can use the alert tool in TradingView, and you mark these levels over here, and you set in the alerts, and TradingView would alert you when a stock price crosses. Or you could use any other any other alerting tool, like even Zerodha's alerting tool, and you can set some prices, and then once the stock crosses that, you can probably buy them as well, right? But the point is, increase your allocation to any stock and make it significant only when it breaks out of stage 1. That's very important. Okay, let's discuss the scanner also. Now, a lot of you might ask me, so how do I know which stocks are coming out of stage 1 and entering stage 2? Now, I have this dashboard which I use always. Most of you might know it by now, but in case you're new to my channel, you can refer to this scanner, which is the CCI weekly crossing 100, which will give you long-term breakouts, especially stocks coming out of a base. Right now, remember, the base, the longer the base, the higher the chances of returns. So in case of this stock, this base, if you see, is almost a 5-year base. Now, bases like this are beautiful. If you even enter the stock and get stop loss hits, don't forget to enter the stock when it breaks out above that base. Okay, that's very, very important. So yeah, that's a scanner. So if you have doubts, do let me know on Twitter or in the comment section, and I will help solve your doubts. So some examples here. Now, this is a Glenmark Pharma chart, which has been in a downtrend. So this is in 2023. Jan, Feb, March is when we had a breakout, but here we had a nice base. The stock was kind of trending down. The EMA was also going down. Then it starts flattening out here, and then it starts rising again. And then we had a breakout also here, along with volumes. Volumes started coming in. We had nice breakout, and I will cover stage 2 separately. But here the point is to understand a stage 1 base, right? Now, that's example of Glenmark. Another example here is Adani Port Special. Now, it need not be necessary that the base is always in a range. Now, we can also have bases like this, right? It also is something that you can look out for, especially when there's very volatile market. You will have such sharp moves down and sharp moves back up. Right now, here again, if you see, there's a stock, the 30-week moving average actually has been going sideways, and the stock has been going up and down, and finally we had a strong move here, which is ultimately the breakout from the stage 1 phase. Right now, that's another example of Adani Port Special. Now, remember, there could be a lot of other examples, and it takes time to understand if a stock is out of stage 1 or not yet. Now, remember, this is not a foolproof strategy, so you might have some losses here and there, but overall, you need to hold on to stage stocks. You should not be holding on to stocks which are in stage 1. You need to enter only when it is breaking out of stage 2. Okay, so that's it for today. Don't forget to subscribe and like this video. Also, 3 more parts will be coming: stage 2, stage 3, and stage 4. I'll be doing 3 consecutive videos for the next 3 weeks. Do stay tuned and watch the entire series. Okay, I'll leave you here. Take care, stay safe, and trade safe. Bye-bye.